Hello everyone. Welcome to Technical Analysis Essentials. This is a fast-track course for beginners. In this course, you'll learn how to analyze price charts, identify the types of markets, and know when to buy and sell an asset, whether it's stocks, futures, or crypto. So let's get started. What is technical analysis? Technical analysis uses past market data to identify patterns and trends to predict future prices. Charts are used for technical analysis to identify patterns and trends visually. There are many types of charts: candlestick, bar chart, line on close, point figure, KJ, Ks, Renko, and more. Candlestick is the most popular type of chart. Why? Because candlestick charts can help you quickly identify candlestick patterns. Candlestick patterns can help traders identify potential market trends and reversals, which I'll demonstrate later in this course. For now, we're only going to learn how to analyze the candlestick charts. If you're interested in other types of charts, you can Google them and research them on your own. Intervals are the time period used to create each bar on a chart. If we choose daily as our interval, then each bar represents one day. The daily chart is the most commonly used for long-term or swing trading. If you're planning on holding your position for more than a day, then you should use daily charts for analysis. For swing trading, daily, 30-minute, and 15-minute interval charts are the most commonly used. For day trading, it's 5 minutes and 3 minutes. And, for scalping, it's 1 minute. Stock symbols, also known as ticker symbols, are unique combinations of letters assigned to publicly traded companies. They are used to identify a specific company's stock when it is being bought or sold on an exchange. For example, the stock symbol for Apple Incorporated is AAPL, and the stock symbol for Microsoft Corporation is MSFT. When you want to buy shares of a particular company, you would use the company's stock symbol to place an order through a broker or online trading platform. Stock symbols are typically composed of 1 to 4 letters, and they are often designed to reflect the name of the company. However, some stock symbols are completely unrelated to the company's name or industry. For example, the stock symbol for Coca-Cola is KO, while the stock symbol for Delta Airlines is DAL. Candlestick charts are commonly used in technical analysis to visualize the price movements of a financial asset. Here we're going to learn how to read a candlestick bar first. Each candlestick represents an interval or a period of time, such as 1 day or 1 hour, and consists of 4 key data points: the opening price, the closing price, the highest price, and the lowest price. On the left, we have a green candlestick. A green candlestick indicates that the closing price was higher than the opening price. The length of the candlestick's body, the green area, represents the price range between the opening and closing prices. A long body indicates a large price movement, while a short body indicates a small price movement. The upper shadow, also known as the wick, represents the highest price reached during the period, while the lower shadow represents the lowest price reached during the period. The length of the shadows can provide additional information about the price movements. On the right, we have a red candlestick. A red candlestick indicates that the closing price was lower than the opening price. By analyzing the shapes and positions of multiple candlesticks, traders can identify patterns that may indicate future price movements. Overall, candlestick charts can provide a wealth of information to traders and investors, helping them to make more informed decisions about when to buy or sell a financial asset. Let's take a quick look at a candlestick chart to see what it looks like. If you're wondering what app I'm using TradingView. Here we have a candlestick chart of Apple. Let's click on the symbol button to change the symbol. Let's enter the symbol TSLA for Tesla. Here we have a daily candlestick chart of Tesla. On the chart, the x-axis represents time, while the y-axis represents the price. The left-hand side of the chart represents the earliest time period being charted, while the right-hand side of the chart represents the most recent time period. The price levels are typically displayed in increments, with each increment representing a certain price range. Let's click on the interval button to change the interval to 5 minutes. Here we have a 5 minutes chart. Each candlestick bar here represents 5 minutes interval. Let's click on the chart type button. Here we can change the chart type to various kinds of charts. For now, let's stick with candlestick charts. A swing high and swing low or pivot high and pivot lows are terms used in technical analysis to describe specific price points on a chart. It is important to understand swing high and swing lows because it helps us identify resistance levels or potential areas of selling pressure and support levels or potential areas of buying pressure. A swing high is a price point where a high is preceded and followed by lower highs. In other words, it is the highest price point in a specific trend or time frame, and it is followed by a decline in prices. A swing low, on the other hand, is a price point where a low is preceded and followed by higher lows. In other words, it is the lowest price point in a specific trend or time frame, and it is followed by an increase in prices. On the top left corner, we have a 3-bar swing high. A 3-bar swing high consists of 3 bars. The middle bar has the highest high and the bar to the left and right has lower highs. On the bottom left corner, we have a 3-bar swing low. For a 3-bar swing low, the middle bar has the lowest low and the bar to the left and right has higher lows. On the top right corner, we have a 5-bar swing high. A 5-bar swing high is similar to a 3-bar swing high, but it has 2 bars to the left and right of the middle bar, and the middle bar has the highest high. On the bottom right corner, we have a 5-bar swing low. A 5-bar swing low is similar to a 3-bar swing low, but it has 2 bars to the left and right of the middle bar, and the middle bar has the lowest low. A 5-bar swing high and a 5-bar swing low are the most commonly used to mark a swing high and swing low point. Both swing highs and swing lows are important for traders as they can help identify potential trend changes or areas of price consolidation. Let's look at swing highs and swing lows on a candlestick chart. Let's click on the Indicators button. Let's enter swing points. Here we can see swing highs and swing lows plotted on the chart. The swing highs and swing lows are marked with the label HH, higher high, HL, higher low, LL, lower low, and LH, lower high. There are 3 main types of trends in financial markets: uptrend, downtrend, and sideways or congestion. An uptrend is characterized by a series of higher highs and higher lows. This means that each peak and valley on the price chart is higher than the previous one. Uptrends indicate that buyers are in control of the market, and the price is likely to continue to rise. A downtrend is characterized by a series of lower highs and lower lows. This means that each peak and valley on the price chart is lower than the previous one. Downtrends indicate that sellers are in control of the market, and the price is likely to continue to fall. A sideways trend, also known as congestion, is characterized by a relatively flat price movement with no clear direction. In a sideways trend, the price moves within a defined range, bouncing up and down between 2 support and resistance levels. This type of trend typically occurs when the market is in a period of indecision, with buyers and sellers evenly matched. Understanding the type of trend that is currently present in the market is important for traders and investors as it can inform their decision-making process. For example, traders may want to avoid taking long positions in a downtrend or short positions in an uptrend, while investors may adjust their portfolio allocations based on the prevailing trend. Here we have an illustration of an uptrend and downtrend. From the illustration, we can see that in an uptrend we have a series of higher highs and higher lows. And, in a downtrend, we have a series of lower highs and lower lows. Here we have an illustration of a sideways market. From the illustration, we can see that in a sideways market price moves within a defined range, bouncing up and down between the support and resistance levels. Now we can recognize when we are in an uptrend, downtrend, or sideways market. What are technical analysis studies or indicators? Technical analysis indicators are mathematical calculations based on the price and/or volume of a security or financial instrument, which traders and investors use to help make decisions about buying and selling. These indicators are derived from charts and graphs that display the historical movements of a security's price and volume, and they are designed to identify trends and patterns that may suggest future price movements. There are many different types of technical analysis indicators, including moving averages, momentum indicators, oscillators, and volatility indicators. Moving averages, for example, help traders smooth out price movements and identify trends, while momentum indicators such as the Relative Strength Index, RSI, and stochastic measure the strength of a trend and whether it is overbought or oversold. Oscillators, such as the Moving Average Convergence Divergence, MACD, help identify when a security may be about to change direction, while volatility indicators such as the Bollinger Bands measure the amount of price variation in a security. In this course, we will go over the moving average, stochastic, and Bollinger Bands indicators. A moving average is a commonly used technical analysis indicator to measure momentum. It is calculated by taking the average price of a security over a specific period of time, and then plotting that value on a chart to identify trends and potential reversal points. The most popular periods of time used to calculate a moving average are 20, 50, 100, and 200 days. For example, a simple moving average, SMA, for a 20-day period would be calculated by adding up the prices of the security over the past 20 days and then dividing that sum by 20. This value is then plotted on a chart as a line, which smooths out the price movements and helps to identify trends over time. Moving averages are often used by traders to help determine support and resistance levels, as well as to identify potential entry and exit points for trades. For example, if a stock's price crosses above its 50-day moving average, this may be seen as a bullish signal indicating that the stock is likely to continue rising. Conversely, if the price falls below its 200-day moving average, this may be seen as a bearish signal indicating that the stock is likely to continue falling. There are different types of moving averages, including simple moving averages, SMA, exponential moving averages, EMA, and weighted moving averages, WMA, each with its own calculation methods and uses. Let's take a look at a moving average plotted on the chart. Let's click on the Indicators button. Let's type in 20-day and select the 20-day moving average. Here we have a 20-day moving average plotted on a candlestick chart. The 20-day moving average is represented by this yellow line. When prices are above the 20-day moving average, prices are moving in an uptrend, and when prices are below the 20-day moving average, prices are moving in a downtrend. Moving averages is a quick way to visualize which direction prices are moving towards. A stochastic oscillator is a technical analysis indicator used to measure the momentum of a security's price movement. It compares the closing price of a security to its price range over a specified period of time, typically 14 days. The stochastic oscillator is based on the idea that as a security's price increases, its closing price tends to be closer to the high price of the period, and as the price decreases, its closing price tends to be closer to the low price of the period. The oscillator measures the distance between the current closing price and the range of prices over the specified period of time and then plots this value as a percentage between 0 and 100. A reading above 80 is considered overbought, which means that the security may be due for a price correction or reversal to the downside. Conversely, a reading below 20 is considered oversold, which means that the security may be due for a price correction or reversal to the upside. Traders may use these levels to help determine when to enter or exit trades. There are different variations of the stochastic oscillator, including the slow stochastic oscillator and the full stochastic oscillator, which use different formulas and time periods to calculate the indicator. The stochastic oscillator is one of several momentum indicators that traders use to help identify potential buy and sell signals in financial markets. Let's take a look at a stochastic added to the chart. Let's click on the Indicators button. Let's type in slow stochastic. and select Slow Stochastic. Here we have a stochastic oscillator plotted on the candlestick chart. The red line is the slow D and the black line is the slow K. The two dotted lines represent the oversold price of 20 and the overbought price of 80. When the prices are above 80, the market is considered overbought. When prices are below 20, the market is considered oversold. Bollinger Bands is a technical analysis indicator used to measure a security's volatility and potential price movements. It is named after its creator, John Bollinger. Bollinger Bands consist of three lines plotted on a chart. The middle line is a simple moving average, SMA, typically based on the security's closing price over a specified period of time, and the upper and lower bands are calculated based on the security's standard deviation from the moving average. The upper and lower bands are typically set 2 standard deviations away from the moving average. The purpose of Bollinger Bands is to provide a visual representation of a security's volatility. As the price of the security becomes more volatile, the bands widen, and as the price becomes less volatile, the bands contract. When the price of the security approaches the upper or lower band, it may suggest that the security is overbought or oversold, respectively, and a potential reversal or correction may be imminent. Let's take a look at a Bollinger Band plotted on the chart. Let's click on the Indicators button. Let's type in Bollinger Band and select Bollinger Band. Here we have the Bollinger Band plotted on a candlestick chart. The blue lines are the upper band and lower band, and the orange line in the middle is a 20-day moving average. The upper band and lower band are 2 standard deviations away from the 20-day moving average. Traders often use Bollinger Bands to identify potential buying or selling opportunities. For example, if a security's price approaches the lower band and then begins to rise, this may be seen as a potential buying opportunity. Conversely, if a security's price approaches the upper band and then begins to fall, this may be seen as a potential selling opportunity. Overall, Bollinger Bands are a useful tool for traders looking to identify potential price movements and volatility in financial markets. A trend line is a straight line that is used to represent the general direction of a set of data points. Trend lines are used to help traders identify trends in stock prices. Drawing a trend line in a stock chart involves identifying the general direction of the stock's price movement and then drawing a line that connects 2 or more significant price points. Swing highs and swing lows are generally used as the price point to draw a trend line. To draw a trend line, draw a line connecting a swing low and a higher swing low or a swing high and a lower swing high. Let's draw some trend lines on the chart. Let's click on the trend line tool on the left. Let's select a lower low and a higher low to draw a trend line. Next, let's select a higher high and a lower high to draw our next trend line. Here we've drawn 2 trend lines. Chart patterns are specific formations that appear on a chart, which traders use to identify potential buying or selling opportunities. These patterns are created by the movements of price and volume and can signal a continuation of an existing trend or a potential reversal. There are many different types of chart patterns, but some of the most important ones that you need to know include double top, double bottom, head and shoulders, falling and rising wedge, bullish and bearish rectangle, and bullish and bearish pennant. We suggest you memorize these chart patterns and be able to quickly identify them on a chart. Chart patterns are often used in conjunction with other technical analysis tools, such as support and resistance levels, moving averages, and momentum indicators, to confirm trading decisions. While chart patterns can be a useful tool for traders, it's important to remember that they are not foolproof and should be used in combination with other forms of analysis to make informed trading decisions. Here we have an illustration of bullish chart patterns. Double bottom, a pattern that forms after a downtrend. It consists of 2 price peaks or valleys that are roughly equal in height and is considered a signal that a reversal may be imminent. Inverted head and shoulders, a bullish reversal pattern that typically forms at the bottom of a downtrend. It is named for its resemblance to the shape of a head and shoulders, but upside down. The pattern consists of 3 troughs, with the middle trough, the head, being lower than the 2 shoulders on either side. The pattern is completed when the price breaks above the neckline, which is a trend line drawn across the tops of the shoulders. This breakout signals a potential reversal of the previous downtrend, and traders may use it as a buy signal. The inverted head and shoulders pattern is often viewed as a strong bullish signal, as it suggests that the selling pressure that was driving the previous downtrend is starting to ease, and buyers are beginning to take control. Bullish channel. The bullish channel pattern is a technical chart pattern that is formed when a stock or any other financial instrument is trending upwards within the boundaries of 2 parallel trend lines. The upper trend line acts as a resistance level and the lower trend line acts as a support level. In a bullish channel pattern, prices tend to move higher in a series of peaks and troughs that are bounded by these 2 trend lines. This pattern is often seen as a sign of a strong uptrend, as the stock or instrument is moving higher in a controlled and predictable manner. Traders often use this pattern to identify potential buy opportunities, as they may look to enter long positions when the price approaches the lower trend line, support, with a target of selling when the price reaches the upper trend line, resistance. Bullish flag. The bullish flag pattern is a technical chart pattern that is often seen as a continuation pattern, meaning that it signals a potential continuation of the previous uptrend. It is formed when the price of a financial instrument has a strong upward move, called the flagpole, followed by a period of consolidation in the form of a sideways or downward sloping channel, the flag. The bullish flag pattern is characterized by 2 parallel trend lines that act as support and resistance levels, with the flagpole representing the initial upward move in price. During the formation of the pattern, the price may experience a pullback, but it should not break below the lower support line. Once the consolidation period is complete, the price may then break out to the upside, indicating a potential continuation of the previous uptrend. Traders may look to enter long positions when the price breaks out of the flag pattern, with a target of selling when the price reaches a predetermined level. However, traders should be cautious and confirm the pattern with other technical indicators, as false breakouts can occur. Bullish rectangle. The bullish rectangle pattern is a technical chart pattern that is often seen as a continuation pattern, meaning that it signals a potential continuation of the previous uptrend. It is formed when the price of a financial instrument is trading within a horizontal range, with parallel lines acting as support and resistance levels. The bullish rectangle pattern is characterized by 2 parallel trend lines, with the upper line acting as resistance and the lower line acting as support. During the formation of the pattern, the price may test both of these levels multiple times, but should not break below the lower support line. Once the consolidation period is complete, the price may then break out to the upside, indicating a potential continuation of the previous uptrend. Traders may look to enter long positions when the price breaks out of the rectangle pattern, with a target of selling when the price reaches a predetermined level. Bullish pennant. The bullish pennant pattern is a technical chart pattern that is often seen as a continuation pattern, meaning that it signals a potential continuation of the previous uptrend. It is formed when the price of a financial instrument has a strong upward move, called the flagpole, followed by a brief period of consolidation in the form of a small symmetrical triangle, the pennant. The bullish pennant pattern is characterized by 2 converging trend lines, with the upper line acting as resistance and the lower line acting as support. During the formation of the pattern, the price may experience a pullback, but it should not break below the lower support line. Once the consolidation period is complete, the price may then break out to the upside, indicating a potential continuation of the previous uptrend. Traders may look to enter long positions when the price breaks out of the pennant pattern, with a target of selling when the price reaches a predetermined level. Bullish triangle. The bullish triangle pattern is a technical chart pattern that is often seen as a continuation pattern, indicating that the price is likely to continue in the same direction after the pattern is completed. The bullish triangle pattern is characterized by a flat resistance level and a rising support level. As the price approaches the resistance level, it may experience brief pullbacks, but should not break below the rising support line. When the price breaks through the resistance level, it is often seen as a bullish signal, with traders looking to enter long positions. Bullish wedge. The bullish wedge pattern occurs when the asset's price is moving in an overall bullish trend before the price action corrects lower. Within this pullback, two converging trend lines are drawn. The consolidation part ends when the price action bursts through the upper trend line or wedges resistance. Here we have an illustration of bearish chart patterns. These are just the mere opposite of the bullish chart patterns, so we will not go into details here. Candlestick patterns are a type of chart pattern used in technical analysis to help traders identify potential market trends and reversals. Candlestick patterns are formed when a series of candlesticks exhibit a specific arrangement or combination of bodies and wicks, which can indicate bullish or bearish sentiment in the market. There are over 60 different candlestick patterns, each with its own interpretation and significance. The important candlestick patterns that you need to know are hammer, shooting star, engulfing, piercing line, and three-line strike. Here we have an illustration of the 8 most important candlestick patterns. The hammer candlestick pattern is a bullish reversal pattern that is typically observed at the bottom of a downtrend. It is formed when the price opens near its high, then drops significantly during the trading session, but ultimately recovers and closes near the opening price. The result is a candlestick with a long lower wick, also called a shadow, and a small real body at the top of the candlestick. The hammer pattern suggests that the selling pressure has been exhausted and buyers are starting to enter the market, creating a potential shift in momentum from bearish to bullish. The long lower wick represents the lower prices that were reached during the session, and the small real body at the top represents the higher prices at which the session closed. The bullish engulfing candlestick pattern is a bullish reversal pattern that occurs at the end of a downtrend. It is formed when a small red candlestick is followed by a larger green candlestick, with the body of the green candlestick completely engulfing the body of the red candlestick. The bullish engulfing pattern suggests that the bulls have taken control of the market after a period of selling pressure. The small red candlestick shows that the bears were in control initially, but the larger green candlestick indicates that the bulls have stepped in and taken over. Traders often view the bullish engulfing pattern as a strong bullish signal, and it can be used as a potential buy signal. The bullish piercing line candlestick pattern is a bullish reversal pattern that occurs at the end of a downtrend. It is formed when a red candlestick is followed by a green candlestick that opens lower than the previous close but then closes above the midpoint of the body of the red candlestick. The piercing line pattern suggests that the bulls are starting to gain control after a period of selling pressure. The opening price of the green candlestick below the previous close shows that there is still some bearish sentiment, but the price then rises significantly during the trading session and closes above the midpoint of the previous candlestick's body. This indicates that the bulls are starting to push prices higher, potentially signaling a trend reversal. Traders often view the bullish piercing line pattern as a strong bullish signal, and it can be used as a potential buy signal. The bullish three-line strike candlestick pattern is a bullish reversal pattern that consists of 4 candlesticks. It occurs during a downtrend and is characterized by 3 black/red candlesticks followed by a larger green candlestick. In the pattern, the first 3 candlesticks are bearish and have a downward trend. On the 4th day, a large bullish green candlestick is formed, which completely engulfs the bodies of the previous 3 candlesticks. The green candlestick is also usually accompanied by high trading volume, which indicates strong buying pressure. The bullish 3-line strike pattern suggests that the bears have lost control of the market, and the bulls have taken over, leading to a potential trend reversal. Traders often view this pattern as a strong bullish signal, and it can be used as a potential buy signal. The bearish candlestick patterns are just the mere opposite of the bullish candlestick patterns. There are many different trading strategies used in financial markets such as breakout and breakdown, pullback, reversal, divergences, arbitrage, news trading, scalping, and more. The most suitable one for you as an individual trader may depend on your trading style, risk tolerance, and personal preferences. Breakout and breakdown, pullback, and reversal strategies are the most popular, so we'll be covering these 3 here. A breakout strategy involves entering trades when the price of a security breaks through a key support or resistance level. Traders may use swing highs and swing lows, chart patterns, and trend lines to identify potential breakouts. Breakout trading strategies aim to profit from short-term price movements and require discipline to manage risk and avoid false breakouts. The pullback trading strategy is a popular approach used by traders to take advantage of short-term price movements. The basic idea behind the pullback strategy is to identify a trend in the market and then look for temporary pullbacks or retracements in price before the trend resumes. Traders may use indicators such as the moving averages, swing high and swing low, supply and demand zones, and trend line to identify pullbacks for entry. The reversal trading strategy is a popular approach used by traders to take advantage of major changes in market direction. The basic idea behind the reversal strategy is to identify when a trend is about to reverse and then enter a position in the opposite direction. Traders may use chart patterns, candlestick patterns, and technical indicators to identify reversals for entry. There are many trading platforms available for trading stocks and futures, both for individual traders and institutional traders. Below is a list of some popular trading platforms. TradeStation, a platform that offers advanced charting and trading tools, as well as access to a range of markets and products. AmiBroker is a popular charting and analysis software used by traders and investors for technical analysis of financial markets. It is a comprehensive platform that allows users to create, test, and optimize trading strategies using historical data. MetaTrader 5, a popular platform for trading stocks, futures, and forex that offers advanced charting and trading tools, as well as automated trading options. TradingView, a web-based platform that offers real-time market data and charts, as well as social trading features and a marketplace for trading strategies. Trader Workstation, a popular platform offered by Interactive Brokers for trading stocks and futures that offers low commissions and access to a wide range of global markets. Thinkorswim, a desktop-based platform offered by TD Ameritrade that offers advanced charting and trading tools, as well as access to a range of markets and trading products. Power eTrade, a well-known platform offered by eTrade that offers access to a range of markets and products, as well as a user-friendly interface and trading tools. That's all for this course. We hope you enjoyed this video. If you like this video, don't forget to hit the like button and subscribe to our channel. There will be more upcoming videos, so you don't want to miss out. You can also follow us on Instagram at AirTrader. There you can find images of chart patterns and candlestick patterns that you can save to your phone or computer for future reference. Thank you for watching.